The AOL case study illustrates the dynamics of growth and decline in the Internet industry. In 1999, AOL had achieved widespread adoption, with households using its service and the "You've Got Mail" message becoming a cultural reference. January 10, 2000, Steve Case and Jerry Levin announced the merger of AOL and Time Warner. The $165 billion deal was the largest merger recorded, resulting in a combined valuation of over $350 billion. This was viewed positively by the market as a combination of Internet and media strengths. By 2002, the company encountered major setbacks. A $99 billion loss was announced, the largest of its kind. The stock value decreased by 90%, and subscriber numbers fell sharply. AOL, which had been key to expanding Internet access in the United States, was now viewed as an example of over-ambitious corporate strategy. The story of AOL goes beyond technology. It involves the exercise of power, the impact of denial on decision-making, and the moment when a vision for the future does not match the reality of its timing. This script examines the rise and fall of AOL to highlight key strategic lessons in business development and adaptation. The analysis focuses on decisions made at different stages and their long-term consequences for the company and the broader industry. The origins of AOL can be traced to 1983. Steve Case, a marketing professional who had worked at Pizza Hut, joined a struggling startup known as Control Video. This company offered Atari games through phone lines. When Control Video collapsed, Case identified a key opportunity: the potential for ordinary consumers rather than only technical enthusiasts. To seek digital connections, in 1985, Case collaborated with Jim Kimsey, who brought an operational approach, and Mark Serif, the technical architect. They restructured the effort as Quantum Computer Services, raising $1 million and operating from a modest Virginia office with a small team of about a dozen employees. Their initial product, QLink for the Commodore 64, was text-based and experienced financial losses. Established competitors such as CompuServend regarded it as an unsophisticated option. Case prioritized simplicity as a core strategy. The approach avoided command lines and technical jargon, instead developing a graphical interface designed for broad usability. This decision addressed a significant barrier to adoption in the market at the time. By 1989, the company rebranded as America Online. Elwood Edwards recorded the phrase, "You've Got Mail," which later served as a recognizable element of the service. The early period involved ongoing challenges, including cash shortages and internal board discussions about the company's direction. Rather than shifting strategy, Case maintained focus on building community features such as chat rooms and bulletin boards. This created a sense of belonging for users. Strategic partnerships with companies including Apple and Nintendo provided necessary support to sustain operations. By 1991, Case had become CEO. At that point, the company had fewer than 200,000 users after 6 years of effort. The fundamental bet was that the Internet would not remain a tool for the elite. Instead, it could serve everyone if made accessible and familiar. The strategy centered on establishing the service as a welcoming environment. Before competitors fully recognized the market opportunity, this positioning laid the foundation for subsequent growth by differentiating AOL through user experience rather than purely technical capabilities. In 1992, the company conducted its initial public offering with a market capitalization of $70 million. The decisive growth mechanism was deployed in 1993 when Jan Brandt executed a large-scale distribution campaign. Millions of free AOL CDs were placed in magazines, cereal boxes, and airline seats. At its peak, half of all CDs manufactured carried the AOL logo. The cost per acquired subscriber averaged $35, while the response rate reached 10%, well above the typical 1% benchmark. This marketing tactic produced rapid user acquisition through reduced barriers to trial. The 1996 introduction of unlimited access for a flat monthly fee of $19.95 represented another pivotal pricing shift. Although it caused network congestion and drew Wall Street concern, the policy triggered accelerated subscriber inflows. User numbers rose from 200,000 to 10 million within 3 years. then advanced to 18 million, and ultimately peaked between 25 and 34 million. At the height of this expansion, AOL handled half of all U.S. Internet traffic. Strategic product developments reinforced the position. AIM Instant Messenger introduced buddy lists and private chat rooms, establishing an early form of social networking. Email became accessible to the general public, and the platform functioned as a unified portal for online activity. Targeted acquisitions expanded capabilities. CompuServe was fully integrated, and Netscape was purchased for $4.2 billion to secure a competitive edge in browser technology. As a direct result, AOL evolved from an access provider into the primary gateway to the Internet. Competitive advantage was measured in total minutes spent online, an asset the company effectively controlled. The combination of mass distribution, flat rate pricing, feature innovation, and selective acquisitions generated strong network effects and user habit formation. These moves illustrate how deliberate choices in marketing, pricing, and capability building can convert early market entry into dominant scale when aligned with consumer willingness to adopt accessible technology. The emphasis on time online as the central performance metric further solidified operational focus and market leadership during this period. By December 1999, AOL's market capitalization reached $222 billion. The company held a central position in shaping online behavior and cultural perceptions of the Internet. The film You've Got Mail reinforced brand recognition across mainstream audiences. Everyday discussions about Internet usage routinely referenced AOL as the default entry point. The service influenced daily routines by tying user schedules to its connection process. Political organizations pursued partnerships to reach voters. Through the platform, traditional media companies expressed concern over its growing reach. Internally, the prevailing culture emphasized continued momentum and market leadership. The defining strategic action occurred on January 10, 2000, with the announcement of the $165 billion stock acquisition of Time Warner. This transaction combined online distribution with extensive media content and cable infrastructure. It was framed as a means to achieve lasting synergies between new and established media channels. Market analysts at the time labeled it the deal of the century, reflecting confidence in the potential for integrated operations to create an unassailable competitive position. The decision rested on the assumption that the existing user base and model could be extended through ownership of complementary assets. At that stage, the move appeared to secure long-term dominance across digital and traditional media sectors by aligning content creation with delivery capabilities. Underlying pressures were already forming, even as surface metrics remained strong. Broadband options such as cable modems and DSL were advancing, providing always-on connectivity without dial-up limitations or busy signals. AOL's revenue model and technical infrastructure were built around metered usage and dial-up connections, creating structural vulnerability to these faster alternatives. Competitive offerings from Microsoft's MSN and Yahoo's portal services began to challenge the paid access structure. Internal indicators showed increasing churn as users evaluated alternatives. The transition to advertising revenue after unlimited pricing introduced new fragility as ADD income depended on sustained user engagement that could fluctuate. Leadership assessed broadband as a specialized segment rather than a broad shift. The Time Warner merger was positioned as a protective measure that would combine AOL's audience with content and distribution assets to build a durable moat. This perspective did not fully account for the risk that subscribers would migrate. Once faster options became widely available and affordable, the threat developed through incremental technological progress and competitive entry rather than sudden disruption. Market dynamics favored open high-speed access that reduced the value of curated dial-up environments. The gap between observed performance and emerging realities was not addressed. Through proactive adjustments in infrastructure or partnerships, allowing the competitive position to erode gradually. Following the merger, integration difficulties arose from fundamental differences in organizational approaches. AOL's fast-paced, metrics-driven culture contrasted with Time Warner's established media operations that emphasized traditional content standards and longer decision cycles. Operational priorities from AOL were applied across Warner Bros. and CNN environments, producing friction in day-to-day management. Leadership interactions between Jerry Levin and Steve Case reflected cautious alignment rather than seamless coordination. Bob Pittman advanced aggressive execution standards within the more measured Time Warner setting, resulting in ongoing tension over priorities and reporting. Trust and performance data originating from the Dulles operations diminished over time. Within AOL itself, subscriber growth began to moderate. Executives adjusted reported figures to support stock performance expectations. Subscriber counts were increased without corresponding verification, and certain advertising arrangements involved reciprocal transactions that inflated recognized revenue. These practices represented a gradual shift from expansion-focused operations to efforts aimed at preserving external perceptions. The change occurred as market conditions tightened, turning internal attention toward short-term metric protection rather than long-term product adaptation. This internal dynamic weakened the ability to respond effectively to external pressures and contributed to a widening separation between reported results and underlying business health. The Time Warner merger represented the primary strategic error because it occurred at the peak of the dot-com valuation cycle. AOL's stock was used as currency for the acquisition of a legacy media company, locking in terms that became disadvantageous when market conditions reversed shortly afterward. The Nasdaq decline began within months, eroding the economic foundation of the transaction. Internally, the response emphasized continuation of the dial-up model rather than early investment in broadband assets or partnerships. The belief that brand loyalty would persist through technological transitions delayed necessary infrastructure changes. This choice reflected an assumption that the original success formula would remain relevant without adjustment, limiting options. As broadband adoption accelerated, accounting practices introduced additional vulnerabilities. To meet external expectations, revenue from advertising was recognized through arrangements that lacked full cash backing, and subscriber metrics were adjusted across reporting periods. These actions maintained short-term appearances but eroded credibility when regulatory reviews by the SEC and DOJ occurred in 2002. The resulting $300 million in fines further damaged stakeholder confidence and restricted operational flexibility. Steve Case's central assumption was that the merger itself would constitute a complete strategy. Post-merger integration efforts did not produce the anticipated synergies in content distribution or cable access. Deals with Warner properties underperformed, and the combined entity failed to capitalize on combined strengths. Meanwhile, broadband expansion continued outside the company's control, rendering the core dial-up offering less competitive. Each decision reinforced a pattern in which prior success shaped future choices. The organization operated under the premise that its foundational model could not be surpassed, leading to policies that prioritized defense of the existing structure over adaptation. This approach converted market leadership into a constraint. When consumer preferences shifted toward open, high-speed access, the cumulative effect of timing the merger at a valuation peak, resisting infrastructure evolution, and relying on accounting adjustments created conditions for accelerated decline. The case demonstrates how strategic commitments made at the height of market optimism can constrain future maneuverability when external dynamics change. The dot-com bubble burst in March 2000, initiated a sustained decline in AOL Time Warner's valuation. By the end of 2002, the stock had lost more than 90% of its value. The $99 billion write-down reflected the revised assessment of the merger's worth. Subscriber departures accelerated as users adopted faster and lower-cost alternatives. Churn rates increased significantly, reducing the user base by millions. Leadership changes followed. Jerry Levin departed in 2001, Bob Pittman in 2002, and Steve Case resigned as chairman in 2003. The company removed AOL from its corporate name in 2003, signaling a strategic repositioning away from the original brand identity. Financial reporting continued to record successive write. Culturally, the brand transitioned from a market leader to a reference for outdated access methods. The closed, curated environment that had driven earlier growth now appeared restrictive relative to the open web. The decline unfolded through cumulative losses rather than a single event, As each element of the original model-metered pricing, dial-up infrastructure, and controlled content lost relevance in the shifting market, the combination of valuation collapse, subscriber attrition, leadership turnover, and brand repositioning marked the end of AOL's period of dominance. In 2009, AOL was separated as an independent entity with a valuation of $3.5 billion, representing a substantial reduction from its earlier peak. Under Tim Armstrong, the company pursued a media-focused strategy through acquisitions such as Huffington Post, TechCrunch, and Patch. Some initiatives delivered results, while others incurred significant costs without proportional returns. Verizon acquired AOL for $4.4 billion and integrated it into its digital media operations. The original dial-up service continued in limited form until its discontinuation in September 2025. Steve Case shifted focus to Revolution, investing in broader regional development, and later reflected on the merger by noting that vision without execution equates to hallucination. The company's trajectory from market leader to reduced-scale operation illustrates the lasting impact of strategic decisions. Made during periods of peak valuation and rapid change, AOL's experience demonstrates that success in technology markets depends on the alignment of vision with timing and execution rather than technology alone. The leadership correctly anticipated the central role of the Internet in daily life, yet underestimated the speed and form of its evolution toward broadband and open access. Several principles emerge from the sequence of events. Mergers, executed at the height of a valuation cycle, carry inherent risks when market conditions reverse. Cultural integration between distinct organizational models requires deliberate management to avoid friction that impairs decision quality. Adaptation must precede observable customer shifts to maintain relevance. Finally, performance metrics lose value when they prioritize appearance over accuracy in the end. AOL did not decline because the Internet became obsolete. It declined because the strategies that built its dominance were not updated to match evolving market conditions. Power in any industry remains temporary when leaders stop adjusting to new signals. Timing determines whether a correct forecast translates into sustained advantage. Strategic thinkers may consider how their own organizations monitor the gap between current models and emerging realities before a connection that once worked seamlessly begins to fail. Asterisk, asterisk, asterisk.